This webcast, powered by Phenix Consulting, is about realizing indirect tax objectives. We will show you via these slides that we use in our workshops that the company's business control framework could bring the right VAT message across to senior management. This will not only result in additional indirect tax resources and budget, but also in an upgrade of roles and responsibilities. The outcome is that the different stakeholders work together on issues that exceed the company's risk appetite. Risk-based VAT controls are implemented, and these are aligned with the company's business control framework. Another outcome is that the workforce efficiency is achieved as companies' resources do not longer spend time on further reducing indirect tax risks that are already at an acceptable level. The way of communication we propose will also result in a business case for future investments. For instance, how can tax technology benefit a company's business objectives and realize workforce improvement and better visibility?
Slide 3 describes the indirect tax department objectives. As a first step, it is important to align tax objectives to business objectives. Like any function, the tax function should contribute value in supporting the realization of these business objectives. We have selected a few objectives to show you how this looks like. Besides financial elements, you see that it discusses risks relating to reputation areas as well. Slide 4 is about understanding the business and key numbers. Where do we start? It is important that you understand the company's business model, the absolute amounts involved, the VAT complexity, and the impact of change. That means understanding the key numbers and thus the VAT numbers under management. These are impressive enough to get the proper attention of senior management. In this example, the VAT number, excluding the bad debts and realized savings that needs to be managed, exceeds at least 3.6 billion euro. An error has a direct impact on EBITDA, which is an important business KPI. A mistake of 1% impacts shareholders' value. This simple table shows how important it is to manage VAT. Just a poking question. Is it not strange that many multinationals still do not have a fully dedicated indirect tax function, nor have appointed a global indirect tax leader? Slide 5 is about indirect tax department performance requirements. During the workshop, we discuss the KPIs of the indirect tax function in detail, as it is important to show all stakeholders what an indirect tax function is able to accomplish when it is set up under the right conditions. That means with support and sponsorship of senior management. I refer back to the slide about contributing to business objectives. The slide provides an overview of the deliverables and enablers of the indirect tax function to create, protect, and optimize value in the range of business objectives. Slide 6 shows the difference between traditional tax risk management and tax control framework. Many companies still have an as-is situation around tax risk management, as shown in red on the left, which is fragmented and operates ad hoc and reactive. Indicators are that action is only taken when an email pops up in your mailbox or the phone starts to ring. Tax team, we have a problem. On the right side you see an integrated approach, where the various work streams work together. Risk-based controls are implemented and internally, communication follows the company's business control framework. I will show you an example later on. Slide 7 describes the importance of a group tax policy. As the reporting line of indirect tax is often to the head of tax, we assess during the workshop what has been written and documented from a tax policy perspective. We like to know how the head of tax has derived tax objectives from the company's business objectives. A tax control framework is a system to identify, mitigate, control, and report tax risks, and when this is signed off by senior management, rolling it out within the company becomes much easier. That is why, during the workshop, we focus on realizing integrated approaches, either with the tax function or, for example, internal audit. Slide 8 is about scoping the tax risks. What is considered an unacceptable tax risk? Setting clear boundaries for those responsible for performing tax risk assessments are essential for managing expectations. Note that these examples are for illustration purposes only. During the workshop, the example of a should level of comfort, that is a driver for certain listed companies, is subsequently tailored into a more practical VAT guideline. Slide 9 is about setting roles and responsibilities. It should be clear who the process owner is and what the responsibilities are of the various stakeholders. You can imagine that when a tax policy is distributed and signed off by senior management, executing change will become much easier due to the right sponsorship. Without a proper tax policy, it depends on your influence within your organization to kickstart any change. Often that results in a fragmented approach, as not all stakeholders can be convinced. The outcome is that this negatively impacts defining standardized and global procedures and controls. Slide 10 is about scoping of tax risks in more detail. There are a couple of elements that needs to be considered to determine the materiality of VAT risks. Absolute amounts are the alignment with the way a business control framework sets up a risk-based approach. However, a VAT control framework differentiates, as it is about paying the right amount of tax, but also about avoiding risks that impacts reputation. This slide shows an overview of some risks relating to the company's reputation and potential impact for various stakeholders, such as vendor and customers, but as well tax authorities and external auditors. As we see in our daily practice, often no VAT measurable goals are visible to the CFO, and a wrong perception exists about VAT numbers under management. It is often considered, wrongly of course, a cash in and cash out. As earlier shown, a 1% mistake can be material and impact shareholders' value. VAT neutrality has to be earned and is not a given fact. Slide 11 is about the materiality of tax risks and companies' risk appetite. Scoping of risks based on amounts is fairly straightforward. If a balance sheet item or profit and loss account is higher than a certain value, the risk is considered high. If it is below a certain value, the risk is considered low. The value that drives the classification is set by the organization. A VAT control framework has different objectives, but also stakeholders. Managing risks on absolute amounts only is insufficient, as VAT complexity and the impact of change should be considered as well. Slide 12 is about scoping of VAT risks and inherent risks. In our workshop we used complexity and change as the most important drivers to assess inherent risks. For each of these drivers, we have defined a number of factors that are measurable, that support organizations in concluding on the drivers. To assess complexity, we use the following factors: volume of transactions, diversity of transactions, supply chain model, number of incidents, complaints, and tax audit results, and the volume of manual processing and/or corrections. For change, we use the following factors: the frequency of change in products and supply chain, frequency and volume of change in people and processes, organizations, processes and systems, and impactful events such as merger and acquisition, outsourcing, centralization. Slide 13 is about how the tax risk universe looks like. The result of the risk assessment, materiality, and inherent risk is shown in this table. This table shows a decision tree that is used in making scoping decisions. On the left, the possible results from a materiality perspective is shown. And on the top, the results from the inherent risks are shown. On the intersect, the conclusion is given whether or not a risk is in scope. Example: if risk from a materiality perspective is high, top row, then regardless of the inherent risk, the conclusion is that the risk is in scope. If materiality risk is considered low, and the inherent risk as well, then the result is that the risk is not considered in scope, the right bottom cell. For a certain combination, the decision tree shows depends. It is up to the organization to conclude about the scoping. This decision needs to be properly documented with the considerations that have been taken into account. Slide 14 shows an example of risks of setting up a shared service center with a focus on complexity. Accounts payable is normally outsourced to such a center, and the VAT handling of incoming invoices is a top VAT risk area. Often the VAT determination of such invoices is done by AP clerks that lack proper VAT knowledge. Change in roles and responsibilities can have a huge impact, and it is not always easy to explain this to senior management. This and the next slide explain the impact of such outsourcing using the Business Control Framework method to its full potential. This slide explains the complexity as element of determining inherent risks, as explained earlier in detail when discussing scoping of VAT risks. Slide 15 shows an example of risks of setting up a shared service center with a focus on change. This slide explains change as element of determining inherent risks. Important non-routine transaction areas are merger and acquisition, outsourcing, or centralization of business models. But change can also be a new supply chain or updated VAT legislation by which an update of VAT instructions is needed or new processes and controls have to be set up. Slide 16 provides an overview of top VAT risks with respect to incoming invoices. In practice, many of the incoming invoices are still processed manually. AP clerks, who are not VAT experts, have to select the correct tax codes and thus determine the VAT treatment and reporting. In order to manage this process, detective controls should be executed to check whether this is done correctly. This is labor intensive and poses a major area for VAT errors. It will therefore always be an area of investigation during a tax audit. The AP clerk often fully relies on the purchase order and might be unaware that this purchase order might no longer reflect the actual situation. For example, if the vendor decides to execute the transaction differently from what had been initially agreed upon. The vendor decides to deliver from another country, as locally the goods were not in stock. Slide 17 provides an overview of top VAT risks with respect to outgoing invoices. The VAT determination is often an automated process set up via tax logic in ERP systems. Failures come up due to incorrect setup, resulting in wrong VAT outcome. In order for the customer to deduct the VAT charged, some formal and material requirements should be met, such as invoice requirements. Another important element is that proof via documents should be available when the 0% VAT rate is used. Slide 18 provides an overview of top VAT risks of SAP. Most ERP systems, including SAP, Oracle, GD Edwards and PeopleSoft, are equipped with some form of VAT functionality. However, they typically still require significant configuration and may need to be customized to deal properly with indirect taxes. They will also need to be updated and tested to reflect new contracts and billing flows. Ownership of these tasks must be determined and communicated upfront so that the ERP system can accurately issue invoices from day one. This slide provides an overview of top VAT risks with respect to SAP setup. A similar exercise could be done for Oracle and other IT systems. Slide 19 gives insight in the background and scope of a VAT SAP scan. During an SAP review for VAT, we will verify the proper working of the implemented VAT configuration. This will provide understanding of how changes in the business model, master data, or legislation will have an impact on the implemented VAT configuration. The SAP review will highlight where the VAT configuration could be improved, or if additional control measures should be added to the Business Tax Control Framework. The SAP review can also identify where errors could occur, allowing a more focused data analysis to take place. After the quantification and evaluation of the risks and errors, these are assigned to a risk profile for further testing of risk tolerance. This slide provides an overview of the areas of investigation. Slide 20 explains how a normative VAT control framework could support. A tax control framework, TCF, is an internal control instrument specifically aimed at the tax function within a company. A TCF is not limited to the tax department, but an integrated component of a company's business and internal control framework. Based on many years of expertise in this area, Phenix Consulting developed a normative control framework for indirect taxes, the so-called VAT Control Framework. The actual situation within the organization is then measured against this yardstick, generally resulting in a summary of the differences. Analysis of these gaps and the associated risks may lead to acceptance or to proposals for improvement. It is an efficient and effective approach that challenges the relevant process owners. Slide 21 shows a sample of a normative control framework that can be used as a yardstick. To continue the risk area of incoming invoices, we show you here a benchmark example of a normative AP process. The control activity, the test of control, and the frequency are important for an effective and efficient implementation and shows how an organization is in control. As said, the current as-is process can be measured against, and the outcome results in gaps. A sound decision can be taken whether or not to close. Slide 22 gives an overview of other change management areas that should be considered. We have shown an example that relates to transferring processes to a shared service center and shows the controls that should be implemented to manage the risks that come up. Here an overview of other changes that will be dealt with during the workshop. Slide 23 describes who we are and what we offer. Phenix Consulting is a company led by 6 partners and a team of around 30 employees. Our main business focus is to optimize SAP from a tax, financial, and control perspective. We have offices in Amsterdam, Berlin, and Cologne. Slide 24 provides our contact details for further questions. We hope you enjoyed this webcast and hope to hear from you soon. Feedback is always appreciated.